Investment professionals have long debated over which style of investing earns the highest returns. Some argue that the Dalbar studies, which analyze historic investment performance, provide evidence that passive investing is superior, whereas others criticize the research for failing to properly classify active and passive strategies. So, which style should we employ? And what are the different approaches we can take to investing? We'll dive into these questions and more on today's Plain Bagel. A lot of people think of investing as a form of mathematics, whereby you use set inputs to calculate tangible outputs and make your decisions accordingly. However, investing is a lot more like playing an instrument than solving algebraic problems. You see, math offers a concrete model where a given problem only ever has one solution. But there are many different styles in investing, each of which offers their own approach, kind of like how there's more than one way to play the drums. Rock drumming, for example, is very methodical, playing on the beat of each song to keep time for band members, whereas jazz drumming often plays around the beat, using complex rhythms to flavor the music. Every drummer at some point must decide which style they plan to practice. And likewise, investors must choose an investment approach. So, whether you're looking to create your own portfolio or purchase a fund, you'll need to understand these different styles and decide which one best suits your needs. And while there are hundreds of styles out there, at the core of each is a subscription to either the active or the passive school of thought. These philosophies provide conflicting views on whether investors should try to beat the market when investing, and before selecting a style, you need to understand this fundamental dichotomy. Passive investors, on the one hand, believe that there is no way to consistently earn a higher return or beat the overall performance of the stock market, which simply refers to the cumulative performance of all stocks. This viewpoint argues that it is too expensive to research and stock pick individual holdings, and so investors instead should focus on diversifying and employing buy and hold strategies to reduce costs and more or less mimic the markets, which they believe in the long term will earn a positive return. Active investors, on the other hand, believe that the stock's price will often differ from its intrinsic value, or how much the stock is actually worth, creating opportunities to earn extra returns. The premise behind this belief is that investors are irrational, falling victim to cognitive and emotional biases that cause them to transact shares at illogical prices. As such, active investors look for opportunities to transact when the price of a stock differs from its intrinsic value. These differing viewpoints will impact how an investor's portfolio transacts its holdings. For example, say we have an active and a passive investor who both decide they want to purchase security A. The passive investor will go ahead and purchase the security on day one, whereas the active investor will instead decide whether or not now is a good time to buy. Through analysis, they may decide, for example, that the stock is currently overpriced and will wait until the stock's price falls. If they are correct, then they will be able to buy the same stock at a lower cost and earn a higher return than the passive investor. But clearly there's a risk here in that the stock price may never fall to its expected level. Likewise, if the price of this security shoots up on a given day, passive investors will hold off on selling the security, whereas active investors may take advantage of the temporary upswing. But there's the risk that the price will continue to rise. Naturally, there are pros and cons to both of these approaches. A great aspect of passive investing, for example, is that it is cheaper to employ, given that there is less research and fewer transactions involved, which gives the style a bit of a natural advantage over active investing. However, passive portfolios are correlated to market performance, meaning that passive investors are heavily exposed to market downturns, which can be difficult to bear. Active strategies, on the other hand, can employ techniques to hedge portfolios against market downturns. For example, they may sell their holdings before a decline, meaning that they will outperform during recessions. This added attention, however, is what leads to the higher fees for active strategies, and still may not yield better results. The active versus passive debate is a fierce one, but each approach offers its own strengths, and the performance of each will differ depending on the economic environment. Passive investors typically perform best when there is low market volatility, or when prices are steady, whereas active investors outperform during periods of high volatility, when prices fluctuate more dramatically. Basic economic theory suggests that markets continually flow in and out of high and low periods of volatility, meaning that there will be periods of time when active strategies outperform passive strategies and vice versa. Past this fundamental dichotomy, investors also follow different ideologies regarding how they should pick their holdings. Again, while there are many different approaches at the granular level, there are three high-level methods for stock picking: fundamental, technical, and quantitative analysis. With fundamental analysis, investors will research a company's business, taking a look at their assets, income, management information, and other points of data, and then use this information to estimate the value of the firm. For example, fundamentalists will look for companies that have a strong leadership team, a consistent profitability track record, and a solid business structure. Then, these analysts will value the company and look for opportunities where they believe a company is trading at a different price than its actual worth. The fundamental style is pretty common among mutual funds and other popular investment vehicles, given its relatively sound economic rationale. However, some critics argue that given the number of qualitative inputs and judgment calls involved, there's no consistent approach fundamentalists can use to beat the market. The second approach to valuation is technical analysis. Technical investors believe that stock prices follow various patterns, and that by identifying these patterns, you can predict when values will increase and decrease. As such, technical investors pay little attention to a firm's fundamental information and instead analyze historic prices, looking for these patterns to help guide their investment decisions. Some examples of patterns used in technical analysis include head and shoulders, double tops, triangles, and flags. Technical analysis is often criticized for its lack of economic rationale and its focus on historic information. However, advocates argue that all relevant information is reflected in a stock's price, making it the only data point worth analyzing. The final valuation method is quantitative analysis, a style that has gained popularity with the evolution of data science. Quant investing focuses on using mathematical models to objectively determine which securities should be bought and sold. Through statistics, quantitative investors look to establish relationships between financial factors, such as trading volumes and company earnings, and then use established models to make decisions. One of the most famous quantitative models around is the Black-Scholes model, which is used to price stock options, a form of derivative. Many advocates of quantitative analysis believe that the method offers a scientific approach to investing. Unlike fundamental analysis, it completely ignores qualitative factors, such as a company's product quality, and provides objective outputs. However, concerns about the style include the potential for data mining and the inability of models to update with changes to the field of finance, which is very dynamic. So, we have three totally different styles of analysis. And while some investors focus on just one of these, others will use a combination to formulate their investment conclusions. But these styles are very high level. There are many more granular approaches to stock selection. For example, some analysts employ growth investing, focusing on companies expected to experience high sales growth in the future, while others are value investors, choosing companies with more established businesses. Some focus on small cap or smaller sized companies, while others select only large cap firms. Some take a top-down approach, researching the economy before choosing their stocks, while others go bottom-up, establishing economic views based on their stock picks. And there are many other ways by which investors can specialize their approach, given the array of options we have. But by understanding the underlying philosophies, you'll be better equipped to understand the types of services available to you. And at some point, you too can establish which style you wish to practice under, whether it be active, passive, rock, or jazz. And with that said, we're out of time. If you like this video, please hit the like button. And if you like what we're doing here, please subscribe. If you have any feedback or topics you'd like to leave for the video, leave a comment down below. For The Plain Bagel, my name is Richard Coffin. Thanks for joining me today.